A company is paying you a dividend. Great. But here's the most important question investors forget to ask. Can the company actually afford to keep paying that dividend? That's where the dividend payout ratio becomes extremely important. In today's episode, I'll explain what it means, how to calculate it, and how I use it when looking at dividend paying companies. So, hello everyone, and welcome back to Suujish Dividends and to another episode of Dividend Diaries. In our previous episode, we discussed dividend yield and why simply chasing a high yield can be a mistake. So, today we are going one step further. Let's understand dividend payout ratio. So, what exactly is a dividend payout ratio? In simple terms, the dividend payout ratio tells us how much a company's earnings are being distributed to its shareholders as dividends. So, if a company earns rupees 100 and distributes 40 as dividends, its payout ratio is 40%. The remaining 60 can potentially be retained by the company for things like expansion, debt repayment, acquisitions, or other business requirements. So, how is it calculated? The basic formula is very simple. Dividend payout ratio is equals to dividend per share divided by earnings per share multiplied by 100. For example, suppose a company earns rupees 20 per share and pays a dividend of rupees 8 per share. So, on applying the formula, rupees 8 divided by rupees 20 multiplied by 100 gives a payout ratio of 40%. That means the company is distributing 40% of its earning as dividends. So, is a lower payout ratio always better? Now, here's where things get more interesting. You might think that a lower payout ratio is always better, but that's not necessarily true. A company paying out only 10% of its earnings might have plenty of room to increase dividends, but it could also simply be choosing to reinvest most of its profits. On the other hand, a company paying out 70% or 80% may be returning a large portion of its earnings to its shareholders, but it has less earnings retained within the business. So I wouldn't look at the payout ratio in isolation. I would look at it together with the company's profits, cash flows, debt, business model, and dividend history. So now the question is, when should you be cautious? So here's the answer. A very high payout ratio deserves a closer look. Now imagine a company earns rupees 100 but pays 95 rupees as dividends. That's a 95% payout ratio. The company is distributing almost all of its earnings. Now that doesn't automatically mean the dividend is going to be cut in future. Some mature businesses can operate with relatively high payout ratios for long periods. But if earnings fall significantly, maintaining that dividend can become much more difficult. And if the payout ratio is consistently above 100%, that means the company is distributing more in dividends than its reported earnings. So that's a major reason to investigate further rather than simply celebrating the high dividend. So one important exception when it comes to REITs and InvITs. There is also an important point for dividend investors in this case. The traditional payout ratio is most useful for regular companies where earnings are a good measure of the cash available for distribution. But when you are analyzing REITs and InvITs, you shouldn't blindly apply the same framework. These structures have different accounting and distribution characteristics. So metrics such as cash flows, distributable cash flow, or the relevant industry specific measures can be more meaningful. So always understand the business structure before judging whether a distribution is sustainable or not. So what do I look for when when I'm looking at a dividend paying company? I don't simply ask what's the dividend yield. I also want to know how much of its earnings is being paid out. Are profits growing? Is the company generating enough cash? Has the dividend been consistent? And most importantly, can this business continue paying and potentially grow its dividend over the long term? That's the mindset I want to bring to dividend investing. So, what are the key takeaways from today's video? Let's have a quick recap. Number one, dividend payout ratio tells us what percentage of earnings is being distributed as dividends. Number two, a lower payout ratio isn't automatically better, and a higher payout ratio isn't automatically bad. Number three, a very high or consistently above 100% payout ratio deserves careful investigation. And number four, don't judge a dividend using one metric alone itself. Look at the entire business. So that's it for today. In our next episode, we are going to talk about something every dividend investor needs to understand, and that is ex-dividend date, record date, and payment date. What do these dates actually mean, and when do you need to own a stock to receive its dividend? I'll help it break it down in the simplest way possible. So, if you're enjoying Dividend Diaries by now, don't forget to like this video and subscribe to my channel Suujish Dividends. I'll see you on next Sunday. Remember, you are building wealth one dividend at a time.